Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 41 is Portfolio Revision. Before going to discuss about the portfolio revision, let us know what are the various concepts that we discussed in the last class. We discussed about portfolio strategies using design derivatives in the previous session. The learning objective of this chapter is to provide an overview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. Once the student attends this session, he will be able to discuss or understand revising a portfolio of an investor. Portfolio revision is one of the pillars of the overall process of portfolio management. It entails assessing the change in portfolio composition over a period of time and taking steps, if required, to get it back in line with the investment objective and risk tolerance framework with which the portfolio was initially constructed. Portfolio revision also helps investors in keeping their investments relevant to changing times and trends. The primary intention behind portfolio revision is to achieve an optimal amount of returns for a given level of risk. Importance. What are the importance of portfolio revision then? Portfolio revision is important in order to keep up with changes in the business and economic cycle as well as market movement. Some other factors also enhance its importance. Changing the amount invested due to a pressing need for withdrawal or increased investable income. Change in risk tolerance due to change in investment objectives or life cycle in order to ensure that even after having to take actions based on the 2 points above, an investor continues to get rewarded for his investments. Portfolio revision becomes an essential activity under the overall umbrella of portfolio management. Portfolio revision strategies. Unlike portfolio construction, portfolio revision techniques can be one of the following two. One is active portfolio revision. As the name of the strategy suggests, an investor or professional portfolio manager is quite hands-on with making changes to the portfolio. The underlying philosophy behind active portfolio revision is that in-depth securities research and analysis can reveal investments which can beat market returns as markets are inefficient. Subscribers of this strategy don't find the idea of market returns appealing and react to changes in market situations in order to gain an advantage over others. However, in order to try to generate greater than market returns and the relatively frequent churning of portfolios, this strategy is costly due to the cost associated with research as well as higher trading costs than a passive strategy. Passive portfolio revision. In passive portfolio revision, The primary aim is to keep earning market returns by executing a buy and hold strategy for the most part. This is not to say that changes are not made to the portfolio at all throughout the investment horizon. Just the portfolio changes are less in number compared to the active strategy, and portfolio managers do not react to every change in the direction of markets. The believers in passive portfolio revision subscribe to efficient market hypothesis, which holds that financial markets are efficient as all available information about a security is available throughout the market and is priced into the security. Due to this belief, this technique finds it futile to try to beat market returns and thus try to equal them. Portfolio changes in this strategy usually take place at a predetermined duration, and due to a little requirement of research and a smaller number of changes, the costs associated with this strategy are low. There are rules associated with the portfolio revision strategy, specifically that which is passive in approach, which decides the changes that will need to be made to a portfolio. These rules are known as formula plans. For the purpose of understanding formula plans, it's assumed that there are two broad uh, divisions of a portfolio: aggressive, which is equity oriented, and conservative or defensive, which includes government and high grade corporate bonds. Formula plans, which are a set of rules determining changes to a portfolio, can be of three types. Construct constant dollar value plan. The constant dollar value plan works with the aim of keeping the dollar dominated equities portions of the portfolio constant. This implies that if the value of the equities portions rises beyond the set dollar value due to favorable market movement, some stocks from that aggressive segment of the portfolio will be sold in order to maintain the constant dollar value predetermined for it. This also works the other way around, in that if the value of the aggressive segment decline because stock prices have fallen, more stocks need to be purchased in order to maintain the constant dollar value. In order to execute this plan, what needs to be decided is the frequency of this change, because that will determine the cost associated with this strategy. Investors need to allow some leeway to the constant dollar value plan in order to ensure that their transaction costs do not eat into their profits, especially in a volatile market where the constant dollar value can be breached frequently. The most prominent aspect of this plan is the ease of execution. Taking into consideration the predetermined action points and periods, an investor is always certain about his fixed exposure to equities, thus alleviating the worry of exposing himself to increased risk. Constant ratio plan. We have another set of rules determining changes to a portfolio, that is constant ratio plan. The constant ratio plan is based on the idea that the aggressive and conservative portions of the portfolio are set according to a ratio. For instance, a ratio of 1:1 between the two segments means that half of the portfolio will be invested in stocks, while the other half would be invested in defensive securities like bonds. On the other hand, a ratio of 1.5 is to 1 between aggressive and defensive segments respectively means that 60% of the portfolio will comprise of stocks while 40% will be invested in bonds. While in both the constant dollar value plan and the constant ratio plan, the equities portion is rebalanced at predetermined periods based on whether stocks have risen or fallen in the sense of predetermined ratio. The constant ratio plan goes beyond the constant dollar value plan by fixing a relationship between the two portions. The other one, which determines the changes to a portfolio, that is variable ratio plan. The variable ratio plan builds on where the constant ratio plans stops stop by providing higher flexibility than the later does. The plan allows the ratio between the aggressive and defensive portions of a portfolio to change either based on market movement or on some preset factors. For instance, a variable ratio plan can allow for a higher ratio of aggressive portion, vice versa. The conservative portion when equities are doing well in order to benefit from the bull run. The plan can also allow for a higher ratio in favor of the defensive portion as an investor grows old and his life cycle demands a more conservative approach to investments. It is important for investors to note that these techniques provide a broad framework for portfolio revision or rebalancing and cannot determine the success of a strategy on their own, that involve security selection in light of investment objective, horizon and risk portfolio of the investors. The session summary can go like this. Using derivatives to reduce risks. Derivatives overlays are used in portfolios to hedge or reduce unwanted risks. These risks are usually market risks, which refers to the sensitivity of an asset or portfolio to overall market prices movements such as interest rates, inflation, equities, and currency. Dear students, let us understand this concept. Furthermore, exercises, that is multiple choice questions. The first question for you is, the primary intention behind portfolio revision is to achieve an optimal amount of dash for a given level of risk. What could be the answer for this particular filling the blank? We have four options. One is A, dividends, option B, sales, option C, returns, and option D. Here instead of typing C and the last option, it could be D. So that the answer is the B. That is, here in this slide it should be C, but by mistakenly it has been typed as B. The answer is C, that is returns. The second question is, an investor or professional portfolio manager is quite hands-on with making changes to the portfolio. What is the name of this concept? So we have four options. One is option A, deactivate portfolio. Number B, active portfolio revision. Number C, portfolio management. D, investment management. What could be the answer for this? Can anybody guess? The answer for this is option B, active portfolio revision. Similarly, we have another question. In dash, the primary aim is to keep earning market returns by executing a buy and hold strategy for the most part. For this filling the blank, we have four options. Option A, return on investment. Option B, activity based portfolio. Option C, negative revision. Option D, passive portfolio revision. What could be the answer for this? Can anybody guess? The answer is option D, that is passive portfolio revision. Like that, we have another question. The dash works with the aim of keeping the dollar dominated equities portion of the portfolio constant. Option A, irregular dollar value plan. Option B, constant dollar value plan. Option C, dollar value plan. Option D, reverse dollar value plan. So what could be the answer for this filling the blank? The answer is option B, constant dollar value plan. Like that, we have one more question. The dash is based on the idea that the aggressive and conservative portions of the portfolio are set according to a ratio. We have four options. Option A, mathematical model. Option B, constant ratio plan. Option C, regression. Option D, statistical plan. What could be the answer for this? The answer is answer B. That is option B, constant ratio plan is based on the idea that the aggressive and conservative portions of the portfolio are set according to a ratio. Like that, there are so many references and books are available for learning this particular concept in detail. So I request all of you to go through these books and references for gaining additional knowledge. Thank you everyone for your patience listening, and I wish you all the best and good luck. Thank you very much. Thank you one and all.